Sustainability investments in South Africa is one of the big topics under discussion in the industry currently. And it's really just how we invest into South Africa Inc. to move us forward in that respect. And I'm joined today by Mr. Mike Adsetts, who's the CIO of Momentum Investments, to share some of their thoughts and ideas around this topic. Mike, good morning.
Morning, Chris. Pleasure to be here.
Fire away. So give us the benefit of your thoughts on this, please.
So I think the starting point is sustainability is really a big topic, and it means different things in different areas. So ultimately, South Africa has very specific needs that need to be addressed that at times coincides with what is happening in the rest of the world, and at other times it's a uniquely South African experience. So, I mean, if we think about sustainability, and one component of sustainability is responsible investing, is the whole area of climate change. Now, climate knows no borders. So the prerogatives for climate and addressing climate change through specific investment interventions is a global phenomenon. There's also on the social side, South Africa has a huge legacy of inequality and a huge need for social investment. So transformation and promoting transformation is in a sense, a more uniquely South African phenomenon, and how you address and go about this is a little bit different depending on the context of what you are trying to achieve. Now, the context of all of this is, as a portfolio manager, we need to make investments that are for the ultimate good of our investors, and that means that we need to deliver returns for them. In terms of how we do that, there are different investments decisions that we can make, and there are other influences and factors that we can incorporate into our considerations, and sustainability is one of them. But there are competing prerogatives in terms of managing a portfolio. So when we talk about infrastructure or sustainable investing, some of the elephants in the room are things like the increase in the offshore exposure. So that changes the amount of available capital that you can invest in your portfolio, and it also changes the nuance of how you address sustainability in a portfolio. So when you think about your offshore allocation, the need there is really, in my opinion, to address more global concerns. So look at decarbonization of a portfolio, look at a climate perspective, and then, at least in the way that I think about it, the need for social investment on the global stage is a secondary concern for me, apart from global issues. When I'm thinking about the local components of the portfolio, then I started to think more about issues around transformation, diversity, and so forth. So it's a very nuanced approach to sustainability, depending on where you want to make your investments. Now, coming to South Africa, a couple of the key issues that are facing us are around infrastructure investments. So we are all very aware of the energy situation and the need for renewable and alternative forms of energy. So that is front and center. And most infrastructure conversations in South Africa at the moment and in the public eye are largely centered around the energy conversations. And that is also the most developed area of infrastructure investments that a private investor can get into, but it's by no means the only investment or infrastructure need that we have. So we've seen in Johannesburg the issue around water and water infrastructure really raising its head. That is a component of the infrastructure investment universe that is still very, very early days. And I'll get back to almost the life cycle of how infrastructure investments become investable over time. The other big one that we need to think about from an SA perspective is transport and logistics. So we have a failing rail entity, and there's a lot of knock-on consequences to that. We have excessive trucks on the road, which in reality should be on rail infrastructure, and without addressing rail and transport and port infrastructure, we really holding the country and the economy back. So just in terms of what makes infrastructure investable or not, there's a couple of things that we need to bear in mind. The one is that most infrastructure investments are unlisted in nature. So as a consequence of that, you do need to think about the liquidity or the illiquidity you expose in the portfolio to, and that's in the context of a lot of other prerogatives, the need to pay benefits, the two-pot system that's coming down the line, the fact that a significant portion of portfolios are now invested offshore, and as a consequence, one of the unintended consequences of that, even in the listed markets out of the large cap space, there's less liquidity in the mid and very much so in the small cap. So those are all factors that you need to bear in mind. Now, another big consideration is bankability of projects. As a fiduciary for clients, my primary objective is to generate returns for clients. I'm not in the corporate social investment space, so I have a responsibility to the clients to first and foremost think of the investment and business case, which has an implication in terms of the types of investment projects or infrastructure projects that you can invest in. So you do need a fertile landscape. And that's why things like energy is a lot more progressed, because in addition to the need for that, the private sector has also been investing in their own energy projects. And a significant portion of the energy projects that we do invest in are related and have been incepted from the private sector. Working in government creates its own level of challenges and considerations. And there you really need to think in terms of where in the capital structure you invest. So you can share risk with an entity or a project, and there you go more for the equity side of the investment. You can move a little bit down into the mezzanine type debts or convertible type debts where you've got a debt profile and maybe some equity upside. And then further down the risk spectrum, you can do debt funding. And to date, our preference for investing with government is through debt, because there's a level of trust in government as a debt partner rather than a level of trust in government as an equity partner. Mm-hmm. So that's very much how we'll think about it. And also you also need to take into account the liquidity considerations, the liquidity profile of an investment from the liquidity profile of a debt investment, where you've got coupons being paid out, they essentially self-liquidating mechanisms where there's regular payments. So that's an important consideration. The other consideration is a lot of these infrastructure projects are massive in scale, especially when you think of the scope of the problem and the type of investments that you can make. So government has a critical role to play, and for those big projects, they might just be too big at beyond a certain level for the private sector individually to contribute to. So there it is really around thinking about consortium syndications and very much on the debt space. So that's an active consideration. So I spoke about the energy space. What we also have seen is in the water space, there are more government projects, and slowly I've come across one or two private sector projects where the private sector is starting to get involved with government, and I see that's the next big issue coming down the line, but that's still in the early stages. These things take many years to reach fruition, and you first need a policy perspective. And with the complexity of the government and competing factions and competing interests, the policy does take a while to clarify and then be transposed into regulation and ultimately to lead to the types of projects that you can invest in and the funding side. So water infrastructure is in its infancy, as well as transport and logistics. So the government is only now starting to grapple and get its head around that what is the role for the private sector to play. We've seen initially with the port in Durban that there's been a large private invested from offshore. So that's good news. And the big issue that government is grappling with is, do they allow access to the private sector, to the rail networks as operators rather than mere customers? So the pace of a lot of the infrastructure investment is incredibly slow. So we've got a keen interest and need for it, but at times it can feel slow and frustrating because of all those elements that I've described: huge competing interests, policy that needs to be formalized, a trust deficit between the private sector and the government that needs to be addressed. And to be quite honest, the only way that's going to be addressed is systematically, stepwise, and through the provision or examples of successful projects. So that is going to take a time to unwind, and it will also dictate the types of investments and where in the risk spectrum you are willing to invest with government. So it's a big question, sustainability. It's very nuanced in terms of how you address it. I spoke a lot about significant infrastructure investments and needs, but there's also social infrastructure that has a huge need, and that is a very tricky one, because there, in my experience, the prerogative of business is investment case performance, and the prerogative for government is social expenditure. So there it is a case of trying to see how can we go and address that. And we have some success stories. So in our funds, we've invested in rural township malls. So that's a bit of a success story. So there we've got a couple of examples. But the need versus the bankable investment opportunities and just simply the funding available is not there. So government also is a critical player in addressing social infrastructure. And that's also going to be a space that we really are grappling our head, because the last thing that we can afford is to make poor investments for our clients. So the consequence is that the demand versus availability of capital from the private sector, in my opinion, there's always going to be a big gap. The allocations that we'll make in our portfolios is going to be significantly less than what government anticipates to come from the private sector. Why? Because we've got so many competing interests. We've got the need to invest in offshore, which from a client perspective is the right thing to do and a good investment decision to make. So there's competing forces trying to get a portion of the allocation from the funds, and these we all need to balance. We'll get to the liquidity needs in a moment, but liquidity also is in a world where there's member choice, where there needs to be accessibility to benefit, and where there is globally a reduction in liquidity in things like bonds, in things like equity, very acute in South Africa as well. These are things that are front and center of my mind and the minds of my portfolio managers in terms of trying to say, okay, what is a prudent allocation, that we try and balance all these competing factors and never lose sight of this, that ultimately we are investing for our investors.
100%. Very interesting. Thank you very much. It's quite insightful. Just one observation. I heard the word climate change in your talk as well. I saw an interesting interview recently conducted on, I think it was MSNBC or something, with Arnold Schwarzenegger, former governor and actor, where he was saying, we keep calling it climate change, but calling it climate change puts it out there somewhere. It's very intangible. It doesn't bring it close and personal. Yeah. And rather call it pollution, call it by its name, the causes of climate change. And I think it just makes it much more personal. It just brings it more into your own personal sphere of reference and influence that you can, if you chuck that piece of paper out the car window, you kind of think about it before you do that. I think it's a very, very, very apt thing of him to say. You also talked about a couple of elephants in the room. There's one in particular I want to just get your opinion on as well, and that is the two pots that's coming up in the very near future. And I think I know we were already seeing this. I mean, have heard comments from all and sundry saying that. I mean, even I get calls on EBnet, people asking me about two pots and how much money is in their pot, and I tell them phone your administrator. But but call centers are, the calls are picking up, the queries are picking up, and I think there's general consensus that when this hits, when this goes live, we're going to see an enormous, call it run on the bank if you wish, because the moment I think you tell people there's money for them, what are they going to do? We get that. So I think it's important that one also looks at the investment side of things, because I think the demand on liquidity to be able to handle that is going to be fairly heavy. But then one shouldn't necessarily also want to compromise your long-term investment objectives. So what are the plans? What is your advice that you can offer funds out there?
So I'll start my answer just saying, what I see in the regulatory environment is there's a lot of well-intentioned regulation, but regulation comes from different places, and there's a lack of good alignment with different pieces of regulation. So if I take most regulation in isolation, I can see the good intent behind it, but when you start layering the regulation, they very often pull in totally different directions. I mean, the previous example I talked about was relaxation of Regulation 28 with more offshore allocation, while at the same need, you've got a massive push and need for infrastructure investment, so which pulls in the opposite direction. And when I think about the two-pot system, I also think of it in that frame. There's a good long-term consequence or implication of the regulation, but there are short-term risks in the regulation. So I think it is worthwhile to think about the unintended consequences. In the long term, a longer, more permanent savings vehicle where you have greater optionality in terms of the types of investments, especially when you think of the types of illiquid or unlisted investments you can make, is a good thing. And I think we do underestimate the short-term unintended consequences. And we're also sitting in a situation where nobody's 100% sure exactly what the frame and the content of the regulation is going. So a lot of the conversation is anecdotal and based on opinion rather than fact. And that's going to lead to some shorter term consequences and a lot of confusion in the member bases, where I've also seen that there's been a lack of communication to members because there's a lack of clarity in terms of what are the implications of the short term of the implementation of the two-pot system. So what are we relatively sure of, or what, in my opinion, are we relatively sure of? I think the March date is pretty much cast in stone. And the reason I say that is because of the political perspective. March is before winter. We should be in a better load shedding situation then. Extreme bouts of load shedding are bad for the ANC government, so they'll be acutely aware of that. And I think they'll be putting a lot of pressure into the system just to try and get that disbursement out before the election to buy some goodwill. So I think the date, at least in my opinion, is fairly immovable, regardless of the preparedness of the industry to implement that. And there's a lot of potential consequences to that. So the one is the need for IT systems to be developed to be able to cater for the multiple pots.
Correct.
Now, there's a need to understand what is the implication from a tax perspective, because the lump sum that will be paid out and accessible is going to be taxable, and there's going to be a cost in addition to the systems and support that needs to come in. So I do perceive that there will be some stress in the short term as people start to realize that it's not their full pot. The money that they get is going to be taxable and subject to fees. So I think that's going to be a consequence that we'll need to deal with. In addition, there is going to be a liquidity need that we'll need to address, and potentially a significant liquidity need. The difficulty is we're not sure exactly to what extent investors or pension fund clients would want to take their benefits. We're working with conservative assumptions and assuming they'd want to take the full benefit, which is a significant amount of money that will be exiting the retirement fund system, and there'll be liquidities and there'll be needs for liquidity in the market. So I perceive that there'll be short-term volatility in the market. I don't perceive it as a long-term volatility. It's going to be an impact in the market, but not worse than impacts like the COVID epidemic, the GFC. So I don't perceive it's going to be that bad. There'll also be differential approaches from different managers in terms of where they source the liquidity from. So when I work with my portfolio managers, we are looking at a waterfall in terms of when the need for the liquidity comes through, where do you start drawing the liquidity? You can get it quickly from cash, then you go to the fixed interest, the equity. The longest time usually to get liquidity out of portfolios is offshore, but we'll know there'll be plenty of liquidity there, so that would be able to absorb the full extent of it. And the liquid exposure, the private equity, the infrastructure is where you won't be able to get liquidity in the short term. So when we think about it, we are thinking about building up from a conservative perspective a little bit more liquidity in the portfolio, being very mindful of the potential liquidity impact and formulating a close relationship with the employee benefits consultants and trying to make predictions in terms of what the draws are going to be.
Right.
So in the short term, I think, yes, there's going to be stress in the market, but I think that will be transient. There'll be stress on liquidity, but that also will be transient. And the big question is to what extent clients or investors will be pulling out of the two-pot system. What's an important message to land, and I think as an industry we're going to have to be very mindful of that, is the whole intent of the two-pot is emergency access. It's not ongoing access. So even though the regulations seem to be allowing thus far an option to take a third of your pot out every year, it's really not the intent of it.
Yeah.
So longer term, from an investment strategy perspective, my view would that there should be very similar strategies on both sides of the pots, with a little bit less illiquid or more liquidity focus on the 1/3 pot, the accessible pot, but really the intention would be to try and withdraw from that pot every year. How it's going to transpire in the industry, only time will tell.
Yeah.
So we're going to have to monitor that. On the 2/3 pot, over time, we'll be able to invest more in the likes of infrastructure and other unlisted opportunities. But that's going to take years to get to a place where we're comfortable and say, this is the right thing to do. So when I do speak to clients, when I speak to portfolio managers, I must say the conversation that I'm having is all about liquidity. It's not about illiquid investment opportunities. So yeah, it's going to be an interesting year.
Absolutely, no, I agree. I think you raised a couple of very pertinent points, and interestingly enough, other topics on this conference also deal with some of those tech issues on the administration platform side, where we've got systems guys really expressing their concern about the ability of administrators or some administrators to be able to handle that. So that's that one thing. The other thing that you also raised is the communication issue. How do we, it's intended for emergencies, as you say. How do we communicate that to people? How do we make them understand, what it's all about? What are the consequences of their actions in terms of taking money out, etc., etc. So, yeah, I agree. There's a lot of issues, a lot of really big things that really concerns us all. And I think it's one of those inflection points that any industry goes through. And I think this is one of them, where it's going to be causing, the cause and effect is going to be quite interesting to watch and see how it all pans out going forward. Mike, thank you very much. I really enjoyed our chat. I think it was very insightful from your side. and I really look forward to engaging with you guys a lot more on these topics going forward. So thanks for your time, much appreciated. Take care.
Thanks, Chris. It was a pleasure.